Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, August 6, 2024 edition of Trading Places Live. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for another trading day. But these days, it's just not another trading day. As you've seen, we've seen some crazy volatility hit the market, something that we hadn't really seen in a long time, with the VIX hitting readings up in the 50s. This is just a sign of how crazy, how volatile, how fearful the market is, and that should be, a signal to you, letting you know that things are going to be a little crazy here for a little while, and there's going to be a lot of emotional trading until the VIX settles down and we move back down below 20, below 17, and into a more comfortable zone in the lower teens, down to even maybe 11 or 12. So the VIX is going to be a big part of what's going on here over the next, at least the next couple of weeks, and then we'll see from there, but probably throughout the third quarter. And, we'll hear lots of rumors, lots of stories about what the Fed might do, what the Fed might not do. Is there going to be an intra meeting, between meetings cut? I think part of that will probably be market reaction and also some of the economic news that comes out between now and then. I would not expect that would be a little bit of out of character, I think, for the Fed to do something in between meetings. They seem to be very calculated in their approach, even though I personally don't agree with some of what they've done or what they're not doing. But it is what it is. And so we have to try and get through these next couple months unscathed, or at least as best we can. Before I get started, I do want to just talk for a second about an event that we have coming up. We literally scheduled it yesterday for today. So at 4:30 today, we're going to be having an event that is going to talk about whether this is a pullback or is it potentially a crash. Are things going to get that bad where we could see things really unfold? I mean, if you've seen what's happened just over the last few days, you know what the potential is for the market and how quickly it can go down, especially with a volatility index. It's already very, very elevated. So I think this is going to be a very timely event. For those of you who were at our July 27th event, where I talked about why I thought the S&P 500 may tumble. Hopefully you got some really good information out of there, because we talked about being extremely careful and cautious about this market, that we saw a number of signs that pointed to a possible big move to the downside. And literally within a week of that, of having that session, you saw what happened. We had a big tumble. S&P 500, which was comfortably above 5,600 not too long ago, dipping down, finishing, I think, yesterday, 52 and change, or maybe that was the low, although I think we got into the 51s. Let's see, yesterday's low was 51.19. We closed at 51.86. So I said back when we were at 5,600, I thought, would not surprise me at all to see 4,800 to 5,000 during the third quarter. And we got down to 51.19 in a week. So, yeah, I think it's a big question. Is this a pullback or is it a potential market crash? And knowing the difference is going to be a big difference in your financial performance for 2024. Because those who think it's a crash and get out and simply just stay out, that could be the wrong answer. And those who are thinking it's a pullback and just, hey, I'm going to ride this out, that could be a problem. So which is it? We're going to talk about that a little bit later today at 4:30 p.m. Eastern. If you're not already a member at Earnings Beats, it's a free event. You do have to be not paid, but you have to be a 30-day free trial member. So you have to give your credit card. We won't charge you until after 30 days are up. So if you don't, if you check the service out, check this event out, don't want to be a member, you cancel. There's no obligation whatsoever. But we do reserve these kinds of events for our members. So if you go to our homepage, you can see on your screen, there's so go over to earningsbeats.com. There's a link right on the front of the homepage. Can't miss it. Register now. Hit that button. It'll take you into then you can register now, come down and give your information and join us for this event this afternoon. These events are pretty big. I've had them before. Members who have been there are very happy they've been there. It's going to I'm going to go through all of the signals I look at from both a short-term and long-term perspective and give you what I'm seeing. I mean, these things evolve. Nobody holds up a sign and says at the beginning of a downturn that, hey, we're going to go down about 10%, or hey, this is going to be about a 30% decline. This is going to be a cyclical bear market, or hey, this is going to be a start of a secular bear market. Nobody holds those signs up. You need to be able to follow the right signals to figure out for yourself and be comfortable with the decisions you're making with your money. So jot this down, earningsbeats.com. Come on over, check it out, register for tonight's event. I think you will be happy you did. All right, let's talk a little bit about the market. Let's talk a lot about the market. So here is a summary of what happened yesterday. We'll quickly go through this. I do want to spend some time going over the major indices today because we've had some pretty significant breakdowns. And so looking at, some of the key areas, the key levels are going to be really important. Now, as you look at this, or while you're just kind of checking this out, let me give you the futures this morning. Yesterday, remember, we get up, well, it started on Sunday evening, but futures were absolutely horrible. And they were just continuing to spiral lower and lower as we got toward the open. We opened on many of our key indices down about 5% on the day, rallied back much of the day. So we printed a lot of hollow candles, which short term, that's a good thing. Normally you would expect at least a temporary move to the upside. Well, that's kind of what we're seeing this morning, although futures this morning are not nearly as strong as they were last night and earlier this morning. But the Dow Jones Industrial Average currently, according to the diamonds, which are the ETF, that's the ETF that tracks the Dow Jones Industrial Average. The diamonds are up about 0.4% today. The spider up 0.4% today. The QQQ tracking the NASDAQ 100 up a little bit more than 0.4% today. And the IWM tracking small caps up a little more than 0.6%, almost 2/3%. So that's what we've got going on this morning with 23 minutes left to the market open. So the reversing type candles, those hollow candles with big volume that we've seen the last couple of days, that suggested to me that probably we were going to see some upside action, at least at the opening bell. And that seems to be what we're pointing toward at this point. Although, like I said, we have 23 minutes to go. So anything can happen. Yesterday, though, looking at the action from yesterday, Dow Jones loses 1,033 points. And we'll get to the chart. I'm going to look at the Dow in addition to the other major indices that we like to follow. But the Dow Jones yesterday down 1,033 points. That was 2.6%. S&P 500 down 160. That was down 3%. The NASDAQ was down 545 points, down 2.96%, almost 3%. Mid-caps down 80. That was 2.7%. IWM down 6.79, 3.25%. And the transports down 269, down 1.75%. And folks, if you weren't watching, that was some of the better levels of the day. We came up off of the lows from earlier. So a little bit of a kick save after a very tough opening bell for another week Monday. Now, those of you who follow me closely know Mondays are the worst day of the week historically. So if you look back 75 years on the S&P 500, the annualized return on Mondays is about minus 15%. And it's worse on the NASDAQ. So Mondays historically are not good. But when you're in a bad market, they always talk about, well, people don't want to hold over the weekend. Well, there's good reason for it. History tells us Mondays are the worst day of the week. And when you're in a downtrend, Mondays can be particularly rough because everybody's got the weekend to think about it. Also, I think there's some psychology in it. Mondays just, who wants to be at work on Mondays? I mean, the Monday blues, right? Anyway, Monday, we started off the week on a really sour note. The good news is we did bounce off those opening lows. Moving on, let's talk a little bit about the sectors, couple industry groups. Technology, the leader to the downside, minus 3.35%. This started with a negative divergence up here on the top. We had a negative divergence. Clearly, we're running out of steam to the upside. This was a huge move for technology. going from about the 190 level or just above 190 at that April low, all the way up to almost 240. That was 50 points, well over 25% in just 3 months, less than 3 months. So it was just a lot. The market needed this break. I don't know if it needed the kind of break we've seen, but it definitely needed a break. It deserved a break. So where are we at now? Well, technology broke the head and shoulder pattern that I pointed out. That was a downsloping neckline. I mean, I said this was an absolutely picture perfect head and shoulders topping pattern on the XLK. We're going into the worst period of the year. We had a lot of economic issues that were very concerning. This has now become the fallout. We broke down below that neckline, went back up, tested that neckline, tested the falling 20-day moving average, and accelerated back down to the downside. This is not good action. It's hard to sugarcoat when you've got 32% of the S&P 500, which that's what the XLK represents, although maybe not that much anymore. But when you've got 32% of the market literally free falling, it's going to be really hard for the stock market to remain afloat. So for all those folks that said, hey, this is an unhealthy market, the Mag 7, this is bad. Mag 7's leading the market to the upside. And, breadth is horrible. Well, now breadth's been a lot better, and you see what you're getting. Big drop in the market. These major indices are market cap weighted. So the companies, when the Mag 7 goes down, it's really hard for the S&P 500 to stay afloat. So just keep that in mind when you're investing in the S&P 500 or in the Dow, that some of these massive companies, the big market cap companies, are really important in these calculations and valuations. Anyway, financials next in line, losing almost 3% on Monday. Had a double top. You can see that low in between the double top was taken out. That's about $1.50 measurement from about 40, little bit over 42.50, which measurement would be down close to 41. We finished yesterday at 40.84. I mean, it is nice to recognize patterns because it does give you an idea of at least initial targets to the downside. That XLK, when I pointed out that we were in that, we had that breakdown. Actually, I pointed out even before we had the breakdown that if it broke down, it would measure down to about 204, 205. That's where we closed on Friday before the big down day on Monday. Remember, these patterns, they're just giving you initial measurement. They're not telling you that it's going to go down to that level and then all of a sudden everything's going to be fine. It's just telling you that when you break that pattern, it gives you an initial measurement to look for when prices further decline. And that's exactly what we saw in both of these charts, the XLK and the XLF. Real estate. Now, defensive groups were doing pretty well until yesterday. We saw everything going down yesterday, including obviously real estate, which had a negative divergence on that most recent high above 42. That means we could be heading for a 50-day test. That's what I look for when I see a negative divergence. First step would be a failure at the 20-day. We went down, we closed almost right on it. We'll see if we get through it. We did fail to hold the breakout level, though, so I think it's just a matter of time before we make our way back down toward 39 on the XLRE. Computer hardware among the industry groups getting hit very hard, down 4.67%. Big down day yesterday in Apple, which let me give you an update on Apple for today. Apple today is down another $2.78. It's down 1.33%. I did not like Apple much for the same reason. I don't really like this computer hardware chart because as we were going up, look at the AD line. I mean, this is why the AD line stays front and center on most of my charts. It just doesn't give you the warm and fuzzies. Doesn't mean the stocks can't go up. I've seen, stocks and indices go up with a weak AD and they just continue to go up. It happens. But I think this is at least something to consider when you're looking at a stock or you're looking at an index, to check to see if the AD line is supporting that directional move, whether it's to the upside or downside. Remember earlier, I think, with Apple anyway, I know I talked about it being manipulated, that when the stock was going down, it was back in the 160s. I thought there was a lot of accumulation taking place, and I thought we'd move back to all-time highs, which we did. Once we broke out and started moving higher, I said, I don't really like the way Apple looks here. And so apparently Warren Buffett didn't like it either. I don't know if he was listening to our show, but he sold half of his Apple holdings. That's, not a minor That's not like just building up a little cash. He had a huge position in Apple and sold half of it. That might have been part of what was going on in the chart, why it's coming through with such a negative AD, line. But anyway, computer hardware breaking down. Now, some might say it broke a head and shoulder top. I don't like upsloping necklines. So I would not personally, I don't call that a head and shoulder, even though, there's a little bit of certainly a lot of technicians would call it that. The reason I don't is because when you break the neckline, you haven't yet established that you're going to move below this prior low. So what I prefer is on like, the XLK over here, a down sloping neckline, because in this case, you already showed enough weakness where you took out the prior low. And that's a big warning sign when you're in an uptrend. So uptrends are basically a series of higher highs and higher lows. So when you get a head and shoulder pattern that's actually down sloping, it's giving you a hint that, hey, the prior low is not holding. What we saw was a very weak bounce up to the 20-day moving average, and then a lot of selling after that in a breakdown. So that's the kind of pattern that would be more concerning to me than one that is upsloping, where when you break down, you may not even go back down and take out that prior low. And in this case, computer hardware went down, took out all the recent lows, and obviously now down below the moving averages. The 20 days declining, it's rolling over, although we haven't yet seen that death cross. It's probably coming. Airlines down 4.8% yesterday. They were already under a lot of pressure. This group, if you look long-term at airlines, they're just up and down. They're really not money, wealth creators, wealth builders over time. I mean, if you look at even the individual airline stocks going back 10, 15, 20, 30, 40 years, they don't perform well. They go through these cycles where they go up for a little while and then back down for a little while. So you have to be a little careful with this group to begin with. I certainly have no interest when they're declining. When they're moving up, I think they're okay for trade. I just want to make sure I get my money because they don't have a long-term history of going up for extended periods of time. So keep that in mind. But right now, airlines not looking good, having a horrible day yesterday. Semiconductors. So we had a double top. We failed at the double top. We've gone down. This is another one which we saw just a little bit of a break. It wasn't any kind of a real pattern. We had a break, though, of this downtrend line, if you will, from this low in June to the low in mid-July. We bounced, got up to about that 20-day moving average, and again, hit the brakes, went right back down to the downside, could not get through the 20-day. When you are rising, how often do I talk about watch the 20-day moving average? Watch that 20-day moving average. It's normal to go down and test it, and it's normal to bounce off of it when you're in an uptrend, at least until a negative divergence emerges. In this case, when you start downtrending, it's the opposite. So every bounce, look out when you get to the 20-day moving average. If we're truly in a downtrend, that's why I always say, if you get a bounce and you're long, take the money and run. If you get through, you can always get back in. What you don't want to do is hold it back down through what we saw here over the last week or so. And with semiconductors, even longer than that. But remember, the stock market a lot, and we're going to talk about this a lot today at 4:30. You have to keep perspective in mind. Everybody thinks the semiconductors are now the worst trade. When I said semiconductors topped back in June, you have no idea how many messages, comments on videos that I was crazy. NVIDIA, best company out there. There's no way NVIDIA is dropping, for the semis to have topped and to go down to certain levels. I pointed out in an article within a month, I thought semiconductors could go down to 16,000 from 21. And within a month, we were down to just about 16,000. Maybe it was 6 weeks. And now we're down even below that. But perspective comes into play because semiconductors ran up from 9,000 to 21,000 in 7.5 months. That is unsustainable. Now you'd think, okay, 9,000 to 15,000 might be unsustainable. To 18,000 is unsustainable. 21,000 unsustainable. We don't know exactly where the top's going to come in. But when you start to see a top form, like we saw with those candlesticks, after a huge move like that, I take no chances. And so to me, it's just more common sense and just the ability to use perspective. It wasn't that I spoke to any of the semiconductor CEOs or got a report that, chip production was down. I didn't know anything of that. All I'm doing is just following the charts, which is why even as a CPA, former practicing CPA, former partner in a big firm, it's why I kind of put fundamentals to the side. I mean, I'm aware of them. I know them. I still follow them. That's what we do here. Earnings beats. But I understand technicals and how important reading these charts are. And part of that is just perspective. And I think a lot of folks, when things are going up, just completely lose perspective and think, oh, NVIDIA, their earnings are growing rapidly and they're, the best company in the world. And they've gone from 100 to, 1,300 or whatever it was since the cyclical bear market. Then they split 10 for 1. Best thing ever. And now some people are saying, well, it was because of the split that they're going down. Split doesn't have anything to do with it. There might be a little psychological advantage, I think, when a price is split. Not a reverse split. Reverse split, I think, is negative psychology. But I think there's positive psychology when you split because you have more shares available. And those who maybe couldn't afford to buy the stock before now can buy the stock. So it opens up some new buyers into the stock when you go from $1,400 stock to 140 or 1,300 to 130 or wherever it was, maybe 120. I don't know. Anyway, my big point here is just make sure that you develop perspective in your analysis of stocks. You really need to be respectful of what's happened in the past, because a lot of times when you have these big moves up, you're going to have these big pullbacks, and it doesn't mean it's the end of the world either. By the way, so we're going to talk about that tonight. Is it the end of the world, or what we seeing, or is this the Great Depression coming on? Is this 3.0, Great Recession 3.0, or is this just a pullback with an opportunity? Because it could be either. And so we'll talk about that a little bit later. Anyway, let's go through, take a look at the 10-year Treasury yield. Now, listen, I've heard all kinds of stories. Everyone wants to come up with why the market's going down. Market's going down because it's going down. That's why it's going down. We can talk about a lot of different things. Personally, I think this was more Fed-induced than anything. I think the market was clearly signaling. I mean, the way I look at the charts anyway, the market was acting in a way as if the rate cuts had already been done, that they were finalized. When you see the small caps absolutely explode the way they did after that CPI report, I'm just reading the tea leaves. The story that the market is telling me, or was telling me, is that that's the final straw. The Fed has no way not to lower and not talk about lowering after that. And yet they did just that. They came back and they said, no rate cut now. And, rate cuts on the table in September, on the table. Well, we've been teased by this Fed before. That is not what Wall Street wanted to hear. Bond market didn't want to hear it. The stock market didn't want to hear it. And yet that's exactly what Chief Powell said. It's back on the table, but we're still data dependent. We still believe inflation could be an issue. He just was not letting go of the inflation story. It was, and the thing is, in the policy statement, which I talked about a couple different videos, but in the policy statement, for the first time, the Fed talked about the fact that now there's a risk to both of the dual mandates. It's not just about inflation. We recognize, that's what they're saying. Hey, we see the deteriorating economy, but we choose to err on the side of keeping inflation in check, even though we're getting signals that inflation's been in check and continues to be in check. We're going to still focus on that. We're going to ignore this over here, the economy weakening. And so I think that was the primary reason personally for me. Now, I've heard all kinds of things. It's the carry trade. It's this, that. I'm sure that all contributed. I've had a lot of questions coming in the last couple of days. Is it the carry trade? Is that? I'm not going to pinpoint that and say it's that. It's probably a contribution. It makes sense to me. All we're talking about is borrowing in foreign countries that offer much cheaper interest rates and then using it to leverage in the stock market, some of the big companies, the Mag 7. And so now you've got kind of a reversal in, what's going on. And as a result, that trade is being unwound. And when it's being unwound, it means those Mag 7 are being sold. And I can't disagree with some of that. I mean, the XLK is leading the charge to the downside. So yes, I think there's probably some, that's partially responsible for what's going on here. But I see so many other things that have nothing to do with the carry trade, or very little. Like, for instance, the 10-year Treasury yield just went down to 367, went to the lowest level that you see on this chart, which is the last year. Bond market's telling us we don't need to look at the carry trade and what's going on with the Mag 7. The bond market is telling us, hey, the Fed just missed the boat. The Fed had an opportunity. The 10-year Treasury yield has been weakening for the last 3 months prior to this Fed meeting. It was already sending a signal to the Fed that inflation was not a problem. And a lot of folks look at this, and I still want to look at the indices, and I know it's 9:26 now. We got 4 minutes, so I'll probably run a little bit over. But a lot of folks think that the Fed or the 10-year Treasury yield is doing, there was a comment on one of my videos, the 10-year Treasury yield's dropping and it's doing the Fed's work. It's not doing any of the Fed's work. It's doing nothing about what the Fed should be doing. The 10-year Treasury yield is a longer term. That's the long end of the curve. That reacts much more to some economic concerns, also inflationary pressures. When we were, under, the threat of much higher inflation, yields took off to the upside because bondholders don't want to be in a bond yielding 2 or 3% if the inflation rate goes to 6%. You're just losing money. So bondholders are going to demand higher premiums or higher interest rates. So they sell bonds. So when you sell bonds, yields go up. You get out of bonds when there's an inflation threat. Well, as the inflation threat dies, so too does all of those moves to the upside. Interest rates come back down to a more normalized range. That's what we've been seeing. So I think what we've got is the bond market screaming to the Fed, inflation's dead. Inflation is dead, and rates are coming back down. People are getting into bonds because if you see deterioration in the economy, then you want to be into bonds because eventually yields are going to go lower, meaning prices of bonds are going to go up. So anyhow, this was another signal to me when the Fed didn't do anything, made no real move towards lowering rates other than to say that it's now on the table. Yeah, that's great. Really? It's now on the table. Anyway, I need to stop. So I think the fallout and the biggest part of the selling you saw was a lack of confidence in the Fed, that the Fed has fallen behind the curve here. They're making a big mistake. They think that they're going to just maneuver away from inflation down the road and the economy is going to be fine. And yet we see the unemployment rate going up. We see initial jobless claims going up just about every week. And once this snowball starts to move and starts to pick up steam going downhill, it's really hard to stop unemployment. People are saying, oh, it's only at 4.3%. Well, it was a lot lower. And so it's not where we're at. It's the trend that the Fed should be concerned about. As more and more people unemployed and filing initial jobless claims, how can the economy do anything but weaken? I mean, doesn't that just make common sense? Less people are working, less people are making money, less people are then spending money. You want full employment. Their mandate is to maximize employment, not to just make sure the level's okay. They want to maximize it. And so when their fight against inflation is done, they should be turning their full attention to the economy. I think the market is saying you should be doing that now, and you're not. And as a result, we're getting a big sell-off. Anyway, let's go through these major indices real quick. The Dow Jones falling down below the key moving averages. If there's any kind of a trend line short term that you were following, that's gone. We do have some lows that we should be keeping an eye on. They're going to be down at about the 37.6, 37.7 level. Yesterday, we got as low as 38.499, finished at 38.703. So we were down 1,033 points. but we were down 1,200 and some points at the low of the day. So was not a good day. Dow Jones not looking good, obviously broken on the chart. S&P 500, similar. I would say the gap downs certainly are more significant. We've seen a lot more selling at the opening bell than we have selling throughout the trading day. If you want to take some positives away from that, I think you can, but it doesn't change the fact that we were at 5,600 a few weeks ago, over 5,600, and yesterday nearly tested 5,100. That is a 10% correction. The high was what? Let me see. I think we hit 10%, but let's just see. 56.69 was the high, so that would be 567 points, which would take us to 5102. We got 5119, so just under 10% on the S&P 500. Moving on, the NASDAQ 100. NASDAQ 100, big gap down, more of a recovery on the NASDAQ 100, but also more of a drop. So bigger drop, a little bit bigger recovery. We're still down below the 18,000 level. We're down more than 10%, well over 10%, probably in the 12, 13% territory. And that's after a pretty big rally. I mean, we came back up 460 points off the low yesterday, losing 545 points. So we were down 1,000 points on the NASDAQ yesterday before that rally ensued. So it made a bad day, or actually it made a horrific day bad. So, but at least it didn't get more horrific. IWM, small caps, also the last 3 days. This is another indication, and this has nothing to do with the carry trade. This group was on fire, thinking that we had rate cuts in the bag. And once the Fed spoke, look at what happened. I mean, completely fell apart. Not only has fallen, but it's given away all those gains that we had to the upside, and has now gone back down to a 3-month low, challenged a 3-month low yesterday in just 3 trading days since the Fed meeting. Thursday, Friday, Monday, 3 days. Poof. That ain't just the carry trade. So anyway, yeah, market not looking good as we go into today. One reminder again, if you came in late, we are having an event at 4:30 today. I really encourage you to come in. It is for members only, but we have a 30-day free trial. You can try us out for 30 days. Just write in and tell us you want to cancel if you don't like our service. I think we've done a lot of really good things for our members over the last 5 years, getting through the pandemic and all. Made some great calls. Going to make another one tonight. I think you should be there. All right, let's take a quick look at what's going on this morning, see if we're holding on to the gains. We are. We got a little bit more gains in the area of the NASDAQ, where we're up about 0.75%. The Dow only up about 0.2%. So we are up. The VIX down 17%, almost 7 points, but we're still sitting at 31. When you have a VIX in the 30s, whatever you're looking at on your screen right now in terms of today's performance can change like that. So I don't trust anything. I do not trade. I won't say I don't trade. I'm certainly not going to be fully invested, and I'll try and maybe pick a trade off here or there. If I lose, I don't really lose a lot. But I don't really like to trade when the VIX is above 20. I've said that many times. To me, it's just, I mean, might as well go to Vegas. I might as well just take my portfolio and put it on red or black. That's kind of the way I feel about the market when we get to the volatility level like this. So I'm not sure that where we're going to be at today's close. I don't know if we're going to have another rally to kind of continue the rally off of yesterday's low, or if all of a sudden we're going to see another big drop like we saw the selling intraday back on Friday or Thursday, probably more so. I think it's just up in the air, and I think that's what the VIX at 31, well now 32, is telling us. I think we just have to be really, really careful right here. So again, come see us 4:30 today. I'd really love to have you guys join, and gals, guys and gals, anyone watching, more than welcome. I'm going to go over a lot of the things I talked about just a little over a week ago. That was on July 27th. Some of the things I warned about, said, watch this, watch that. Well, if you're watching, you know what I'm talking about. But we'll have some more to share with you tonight. Again, perspective will be a big part of it. And just remember that there's going to be something on the other side of this. I think a lot of traders are just impatient. They feel like they got to make money every day. And I just feel like sometimes it's a better time to be preserving my capital than it is to be trying to make money. If the market goes down for the next couple months, sets new lows, and I can go into October with the same amount of capital I have right now, to me, that is a major win. I have a lot more buying power. I could buy a lot more of the same stocks. I mean, I sold NVIDIA in the upper 130s. I would love to see NVIDIA back at 75. Is it possible? I think it's possible. I don't know. I mean, you see how fast it went from, what was yesterday's low, 91 or something on NVIDIA? It had gotten up to 141. It lost $50 since the middle part of June. So what is that, 6-7 weeks? That's a lot. So, never get into that mindset of saying, hey, this can't drop. It can't drop. It's too good. When the market decides it's time to go down, everything goes. So anyway, be careful out there. Again, come see us later today, 4:30. You can go over to Earnings Beats. Just go to our website. If you go to our homepage right here, you'll see the link. It's right there staring you in the face. Come on in and join us at 4:30. Hopefully see you there. Happy trading, everybody.